Hello, this is Strictly Money, and I'm your host, Saijal Patel. Thanks for joining. If the stock market volatility is making you skittish about investing, you wouldn't be alone. Maybe you're second-guessing your investment decisions or avoiding investing altogether because you think it's too risky. What if I were to tell you that leaving all of your money in a savings account is risky as well, and that you can build wealth without losing sleep? Sam Sivarajan is behavioral scientist, and he's the author of Making Your Money Work, The Secrets to Financial Health. And he joins me now. Hi, Sam. Great to have you back.
Saijal, thank you for having me. Great to be back.
So, Sam, you know, when the markets are down, there's panic. When they're up, there's euphoria, and no one thinks it's going to crash. And yet history tells us that there are corrections and there are even stronger rebounds. So, you know, when you know that, why does rational thinking just go out the door?
Well, it's a great point. And I think you put your finger on it, Saijal. I think it's basic human emotions. People are greedy when markets are up, and they're fearful when markets are down. And the reality is that we're all looking for shortcuts. We want to get rich quick. It's simply how human beings are wired. But it's like getting fit. There are no sustainable shortcuts. So the formula for being fit is simple, I should say. It's eat less than you burn, but it's not easy to do. And just like there is no magic diet pill, there is no magic investment.
Right. And I remember you saying at one point that, right, investing is easy or simple, I guess, and not easy.
Yeah, it's simple. What I mean by that is that it's not rocket science. The principles are not difficult to contemplate, but it's not easy because it requires a degree of discipline, self-discipline, and self-awareness. Exactly what you talked about, that knowing that these cycles repeat, but yet not giving into the emotions, whether it's greed or fear at any given moment.
So, Sam, how much does tribalism have a part to do with, you know, this need to belong to something bigger, approval?
So I think what you're talking about, tribalism or social proof from a behavioral science perspective, is something that we use as a shortcut, meaning that if others have invested, we think it must be good. And part of it is that we believe that means that we don't have to do our own homework. So take the Bernie Madoff example. He was able to rip off wealthy investors for over $50 billion and got away with it for so long because everybody assumed that the other person had checked out Madoff. Now, this social proof is everywhere. We see it in our politics. We see it in our fashion. We see it in our taste for music. So as you say, we follow our tribe, and we pretty well ignore any other information that's out there. So in investing, it is what I call the hype cycle. Yeah. We have media and social media that make darlings of certain investments, you know, like WeWork, like crypto, like meme stocks, and we pile in because we're afraid of missing out.
Yeah, and that's a really good point, Sam, because all of this does lead to buying into hype, right? We know that FOMO, or this fear of missing out, is real. We've seen it with crypto, for example. We've seen it even in the housing market. So what do you advise?
Well, I think one thing that you can use is this concept of second order thinking. And what I mean by that is asking repeatedly, and then what? And then what? So what has to go right for things to turn out the way that I would like it to turn out, and what could go wrong? So you mentioned housing. So until March, house prices kept going up, but this second order thinking would have made buyers and sellers think deeper. So what has to go right for housing prices to keep rising? Immigration needs to keep going up. Interest rates need to stay down. The economy needs to grow. The affordability of housing has to rise. And this housing supply has to stay low. Now, we know that since March that none of these things have happened. And so it's no wonder that house prices are falling. And this is the power of second order thinking, asking these questions and answering them repeatedly before making an investment decision, for example.
Okay, so it sounds like it's really about risk management, right? Looking at the probable downside.
Yes, I think risk, as you know, Saijal, in investing is a oft talked about concept, but it's one that is not particularly well understood. So if you are an investor, what most investment firms have you do is to fill out a risk questionnaire. And the focus on this risk questionnaire is supposedly tolerance to volatility.
Welcome back. Sam, before the break, you were talking about risk. So how should people manage their risk? What are some of the things that they need to think about?
So the risk tolerance questionnaires that most investors will fill out when opening up an investment account looks at supposedly the tolerance to volatility that that investor has. And what I mean by that is how much volatility is how much the value of the investment moves up and down. But stock volatility is the one way to think of it is like a roller coaster that does loop the loops. So if you don't try to get off in the middle of the ride and can wait till the ride ends, you should be fine. But if you think you can't handle the loops, it's better for you not to get on the ride at all. And the one concern that I have with this focus on volatility is that I think it misses the fact that investing is all about trade-offs. So a tolerance to the volatility must be traded off against tolerance for fall. Now, you mentioned at the outset, Saijal, that you could keep your money in a savings account, but that there is a risk of doing that. And you're absolutely right. The risk is that you will run out of money in retirement. Now, the alternative is that you can invest in high-risk meme stocks or cryptocurrency, but then you run the risk of losing your capital. And the reality for investors is there is no either-or answer. Every investor will need to balance volatility risk against shortfall risk. And where in that continuum the investor finds themselves most comfortable is what's going to determine their optimal investment strategy. I would say that one way to think of it is at the end of the day, risk is what you buy your return with. The more risk that you take, the more return you can potentially make.
Sam, let me ask you this. I mean, you talked about, when you work with an advisor, and I think you're referring to the KYC form or Know Your Client form, where they're asked a series of questions, and one is definitely on the risk tolerance. Do you think that the industry itself is also missing something, that they don't get that? There's gaps here?
We could have a long conversation about it. I think certainly there is an element of things that are missing. I think the fact is it is very difficult to measure something that is at the moment that it's being measured is hypothetical. So, the industry is saying, okay, investor that, markets go up and down. If you're investing, if you're opening up an account or starting the investing when markets are up, you probably hear it, but you're not paying attention to it. So I think it is very difficult, whether it's the advisor or whether it's a client as an investor, to be able to predict how you're going to react 2 years from now, 5 years from now, 10 years from now, when a market correction occurs, because each time is slightly different and your own personal circumstances is going to be different, from the moment you sign the form to the moment when the event occurs.
And if I'm correct, there's lots of layers to risk, isn't there? There's lots of different types of risk that someone can look at.
There's huge amounts of varieties of risk, that they can look at. We talked about two of them: volatility, which is the standard and principal measure in the industry. I think I talked about shortfall, which in my mind is something that people don't pay enough attention to, the idea of running out of money, especially when you're in retirement. You've got other types of risks like liquidity. So, the challenge that for a lot of people that are in housing as a rental property or investment property or into private equity, et cetera, or some of these alternative investments, you don't have liquidity. So if you want to sell tomorrow because you need the money, you take a risk because the price, you may not be able to sell. And if you do manage to sell, it might not be at the price that you want. And then we talk about, obviously, capital risk, which is that the investment is worth nothing or far less than what you paid for it. That one to me is one of the easiest ones to manage, because this is what we talk about as a diversified portfolio. If you do your homework and you have a diversified enough portfolio, and you hold it long enough, capital risk is, for the most part, I think, a relatively minor risk for investors to worry about.
Okay, we're going to take a quick break, but I also want to make the point, because I know I teach this as well, is know the difference between risk tolerance and risk capacity, because they're two different things, right? You may have a certain risk tolerance, but there might be
Correct.
a certain amount of risk that you actually have to take to meet your goals, and it's important to actually make that distinction.
I think that's a perfect distinction to make. We're going into back to school. So
Yeah.
for parents that have money in an RESP, and if your kids are going to, you're going to need that money in 2 years from now, no matter what your risk tolerance is, your risk capacity may not be that high, because you will need that money in 2 years. And that's too short a time for you to take the type of risk that stock market investing entails.
Okay, we'll take a quick break. We'll be right back. Welcome back to Strictly Money. I'm here with behavioral scientist and author Sam Sivarajan. Sam, you've written a book, and I've read it, and I have to say I love the simplicity of it and how you illustrate concepts through storytelling. Let's talk about some of the lessons that you highlight. And one of them, and I think a very important one, is don't confuse trading with investing. Explain that one.
Well, I think we've seen, Saijal, especially recently, that with crypto and everything else, that the need to focus on fundamentals. So what are you investing in? How is the company making money? Is it sustainable? What has to go right for it to continue making money? So Warren Buffett talked about fundamental human needs, that we will always need to buy food, clothes, shelter, transportation. And so the stock in any company that produces these items, produces them well and profitably, should be a good buy. Hype, on the other hand, is about popularity, not about fundamentals. And investing in any company about fundamentals, rather than trading, is to focus on companies that can demonstrate a path to profitability in the medium term. And so to your point, trading is short-term flipping. Investing is for the long term. And if you think about it, Warren Buffett is not a trader. He's an investor. So focus on companies with long-term fundamentals is how I would distinguish trading from investing. Okay.
Your second lesson is save. Now, it sounds obvious, right? And some people will say, well, I can't. I don't make enough. Everything is really expensive. And I think for many, that is a reality today.
It is a reality. And I think your reaction is absolutely right. I write in the book, obviously, that the reaction is, of course. But it's, as with much in investing, saving is simple but not easy, for a whole variety of reasons. But it's important to remember that what you save is what is left over to be invested for long-term goals. And maybe the best analogy that I can use is that if ice cream is your kryptonite, the best way to avoid it is not to have it in your freezer. So in the similar vein, how do you save? By starting small. Every paycheck, if you can take $20 or $50 and move it directly to your savings account, you will soon see that because it's out of sight and out of mind, you will not even miss the money. And then in a little while later, you can increase by $10 or $20 a paycheck. And then pretty soon you have a nice nest egg that you can consider investing. So again, this is not rocket science, but it's not easy to do, to have that discipline. And all I'm suggesting, and there's research to support it, is that by starting small and moving it directly out of sight, what was initially hard to start becomes an easier habit to follow through on.
Yeah, absolutely. Pay yourself first, right? I remember reading that book, Wealthy Barber, and I do it myself.
Exactly.
And yeah. This one's an interesting one. Invest in yourself.
Well, The point I'm making on this one is that no one should be looking to their investment portfolio to be the primary source of wealth. It is supplement, not a substitute. So our biggest source of net worth is our human capital, the education, the training, and the experience that we bring to work and for which we're paid. A recent McKinsey report actually put human capital as accounting for 2/3 of the individual wealth. And if you think about it, this makes sense. We spend half of our adult lives earning a living. And then what we save from that first half, after taxes, living expenses, is what's left to fund the living in retirement. So, what we save from this human capital, the foundation for everyone's wealth, if invested properly, can grow so that it plugs the gap between what you saved and what you will need to live in retirement. My point is that investing isn't going to make you Warren Buffett, but it doesn't need to. You just need to capitalize on the human capital that you have, that you're invested in yourself, that you're getting from work, your business, or whatever it is, and then be able to, with the money that you've saved that we've talked about earlier, that becomes what your portfolio that you invest that gets a return, to supplement as opposed to substitute for your human capital.
Yeah, great point, because I always say, look, the equation to saving is simple, but again, not easy. You either have to cut your expenses or you have to increase your revenue. And the only way you increase your revenue is, and a big part of it is, again, investing in yourself, right? Because that's the only way you can you can move up the ladder if you call it that. All right, we're going to take another quick break, and we'll be back in 2. Welcome back. I've been talking to Sam Sivarajan about some of the lessons that he imparts in his book, Making Your Money Work. Another lesson, and I tell you, this is such an important one that I think a lot of people don't quite understand, Sam, is the power of compounding, and that you let that do the heavy lifting.
100%. So the power of compounding is what Einstein actually called the eighth wonder of the world. It is where your savings makes money. And it's quite literally, where I got the title for my book, is making your money work. So here's an example. If you want to save $500,000 for retirement, you can start saving $250 a month at age 25, or you can choose to wait till age 45 to start saving. The difference is that at that point, you will need to save $1,000 a month to get to that same $500,000 level. So 4 times as much money that you'll need to save. And this, to your point, Saijal, is exactly where the power of compounding comes in, because for the 25-year-old, they've had 20 years for compounding to do the heavy lifting, so they don't have to save as much money.
Yeah, it's time in the market that matters, doesn't it? Not how much.
Time in the market is way more important than timing the market. You get it in at the bottom and sell at the top. And I think you are so right. So many people spend so much time worrying about, is this the right time to get in, the right time to get out? And I think there's just a better way of doing it. And that is actually the dollar cost averaging, right? So where you buy or sell a little bit over time, it takes away the regret of buying or selling at the wrong time. So I can give an example. If you invest $100 today in a stock trading for $20 a share, you get 5 shares. If you invest $100 in 2 months from now in the same stock trading for $25 a share, you'll get 4 shares. But what's happened here is that over in these 2 months, you've actually invested a total of $200. You received a total of 9 shares, but the portfolio right now is worth $225. So you've made $25 without having to worry about what the right time of getting into the market is. You've just put a regular investing plan, and you've reaped the benefits.
It makes so much sense and so much harder sometimes to do, right? But it's the easiest way as well. Do you think that timing the market though makes sense all the time, or not timing the market? Because I mean, does it make sense just to buy and hold over the long term, or Is there sort of an in-between that somebody should think about taking money off the table?
Well, I think, look, I think obviously, I think as people age and their circumstances change, I think that what's invested in the market, will need to change as you're nearing retirement age. Or we talked about children going to school. Like, you can't stay fully invested in the market because you will need that cash. And so trying to time the exit by staying buy and hold may not make sense at that point. So I think the balance or the compromise is to have a long-term investment strategy, but be ready to adapt that strategy, not for tactical reasons, because you think that there's a war somewhere, or there's interest rates are coming, or trying to time the market in that way, but make changes because from a lifestyle point of view, you're entering a different stage in your life cycle.
Right. So you should look at it when you think about rebalancing. The time to rebalance is when you're something big, like a life event is happening, and you actually need some capital, or your risk tolerance perhaps changes. Does that make sense?
Exactly. I think that you're absolutely right.
Okay. Sam, we really appreciate you coming on. And for viewers, if you want to pick up the book, it's called Making Your Money Work: The Secrets to Financial Health. Sam, where do people pick it up? It's available on Amazon, I'm assuming?
It's available on Amazon as an ebook or as a paperback.
All right. Thanks so much, Sam.
My pleasure being here. Thank you, Saijal.
Well, that does it for this show. If you are nervous about the markets, take heed that investing can be simple. It does require discipline, and you can apply some of the lessons that we discussed today, like not trying to time the market. Right, if you have some questions or comments, please email us. Until then, we'll see you next time.